Good afternoon, everyone. I'm Sarah Greenwood, and on behalf of the MGAA, I'd like to welcome you to our briefing this afternoon, which is being delivered by PwC. Before handing over to our presenters, I'd just like to run through a few housekeeping points. I need to advise you that this session is being recorded, so please ensure that your microphone and camera are switched off. If you'd like to ask a question, please use the chat button at the bottom of your screen. Your questions will be answered during the Q&A session and will remain anonymous. However, if we do not have time to answer these, they may be addressed post-event should you provide your contact details. But there should be plenty of time for Q&A. The MGAA's Programme of Learning and Insights has been accredited by the Chartered Insurance Institute for the quality of content and supporting materials, with CPD hours applicable if relevant to your ongoing professional development. The recording of this briefing will be available on our website and MGAA YouTube channel with a PowerPoint presentation to follow post-event. Finally, I'll be posting a link to a feedback survey in the chat box of this session. Please do take time to complete this, which should take no more than a couple of minutes, as this does allow us to deliver the best quality events to our members. So today's briefing, MGAA Finance, Regulation and Reinvention, is being delivered by Mark Priest, Tim Smith, Sanya Hussain and Alex Juniper, with a brief introduction to PwC from Anthony Joseph. That's it from me now. So Anthony, it's over to you.
Thanks very much, and look, lovely to see you all. Thank you for your time. Hi everyone, I'm Anthony Joseph. I'm a partner in the insurance consulting practice at PwC, and really appreciate the opportunity to talk to you today. Look, we see so much change and opportunity in the market. We see customer expectations are changing more rapidly than ever before. Climate change is accelerating. Risks are becoming more interconnected and more complex. Regulators are becoming more demanding, and obviously digitization, AI is everywhere. In this environment, we see the MGAs are just becoming more and more critical. Your focus on customer insights, innovation, and ultimately driving improved underwriting outcome of being recognized. Over the last few years, we've seen top-performing MGAs deliver top quartile returns with low capital requirements, which obviously has attracted both talent and capital into the segment. So look, at PwC, we have over 2,000 practitioners working extensively across the entire insurance market in the UK and Ireland, including for MGAs. We provide advisory services around risk and reg, operations, finance, HR and technology. Some of the guys you're going to meet know us as well. So look, we're super excited to become probably the newest members of the MGAA, and to have the opportunity to present to you today and continuing the conversation after this session around how we can support your growth. So with that quick intro, I'll hand over to Tim, who's going to sort of kick us off. Thanks, Tim.
Thanks, Ajay. Hi, everyone. I mean, just quickly kind of adding to what Ajay was saying there before moving on to Alex, Mark, Sanya and team and getting to the meat of it. I think, clearly we recognise in the clients we've worked with in the MGA sector, there's a huge opportunity for MGAs, the increase in delegated business and volumes there, product innovation, and also a real pull on underwriting talent. But I think, while that's all great news for the top line, we work with clients quite a lot where those factors cause some challenges in the middle and the back office. And quite often we see that haven't necessarily, and yourselves might not have the scale, the technology, or the kind of the ability to keep up with what's happening at the front end. And I've worked with clients in this sector, in this area where the eye roll from the IT or the finance team that we see when the underwriters come in with a new deal they've done, trying to work out how we're going to unpick that and get the information flowing through is not insignificant. Now, I want to touch on a couple of areas where we see a particular challenge, and unsurprisingly, given today's topic, focusing on risk, kind of compliance and finance, but then swiftly moving on to the team. Clearly, from a risk and compliance perspective in the delegated and MGA space, it's increasing interest to regulators, as Anthony said. Being able to demonstrate customer value, meeting consumer duty, treating the customer fairly across the value chain, and also with your TPAs, etc., is increasingly important, and there's more focus there. Operational resilience in a context of quite often you'll have old systems, you'll have bespoke systems, and being able to demonstrate that you can keep those things going, keep the lights on, is increasingly important. From a finance perspective, I mean, probably one word: data. Trying to work out how you pull in different data from your sub-agents, do what you need to do for your brokers, for your carriers, for your clients, dealing with bordereau, dealing with systems, and the data challenges around that aren't insignificant. And that's where actually we spend quite a lot of time from PwC and what we do working with our clients, both from traditional, advisory support around everything from system selection, system implementation, advisory work on the best way to solve an issue, but also increasingly thinking about how we either augment our team members into your teams to support with certain pinch points around whether that be the data team, IT team, financial risk, but also the managed service where we actually look to take on some of those activities. And that's something we do in the sort of the finance and the risk space, which I think we'll touch on during the presentations. So I think without further ado, then that's sort of a bit of a tee-up of some of the things that we talk about with our clients. But maybe I think, Sally, I'm handing over to you to kick off the reg section. Thanks all.
Thank you, Tim. That's great. Good afternoon, everyone. My name is Sonia Hussain. I am a manager here at PwC. I work within the financial services area in the risk line of service. My focus is insurance regulation with a particular focus on conduct issues. So in terms of what the regulatory update session will cover today, so first of all, I'll summarise some of the key drivers shaping regulation today. And then I'll move on to looking at key general insurance focus areas, both from a prudential and conduct lens. And then lastly, I'll talk a little bit about supervisory priorities, primarily from an FCA and wholesale insurance market. So as I said, the first slide here discusses sort of the risk drivers shaping regulation and the risk landscape, what is making the priorities what they are at both the FCA and PRA. So I think the first thing to say is that the UK has seen a significant amount of regulatory reform over the last few years. And the most recent, I guess, trigger or key milestone was Brexit, where we saw the UK government wanting to remove some of the red tape and deliver opportunities in international competitiveness and growth. We saw a lot of reforms from a prudential perspective, that sort of meaning from a Solvency UK perspective, we saw the PRA do a lot of work over the last couple of years. I think, interestingly, we didn't see the same taking shape from an IDD perspective. In fact, there were some EU delegated regulations from an IDD perspective that were directly applicable, but the FCA kind of lifted and shifted them into FCA rules. And so the regime continues as it is. It's a little reform from that perspective. The next driver here is economic uncertainty and geopolitical developments. So from this perspective, I think what's interesting is that, of course, the world is becoming increasingly interconnected by global flows of goods, services, data, capital, and the list goes on. But of course, this then means that industries, including the insurance industry, is dependent on the political forces of these different geographical environments. And so this, of course, in turn has a result on how firms will want to think about their kind of businesses, their underwriting strategies, their reserving strategies, and their investment strategies. And then thinking about the changing nature of perils, I think what we are seeing here is emerging risks like cyber threats, climate change, and of course pandemics. We recently have just come out of COVID-19. So it's interesting to see how insurers are adapting their product offerings and reevaluating their risk exposures in light of some of these changes that we are seeing in the nature of perils. Another driver, the interventionist approach of regulators. The regulators have categorically and explicitly said that they want to be more assertive in how they supervise firms. And we have seen this taking shape, not least because of the consumer duty and all of the reviews that the FCA is conducting in that area. But of course, this then has an impact on the regulated community, including MGAs, with increased compliance costs and increased operational practices, given the lens and the robustness with which the regulators are now looking at firms. Thinking about social and public policy, so there has been growing pressure on the regulators to better understand how firms incorporate ESG considerations into their insurance products and investment strategies. So definitely an influence from that perspective. And lastly, on this slide, we'll talk about technology and innovation. So We know that the insurance industry is leveraging technology to streamline its operations and to enhance customer experiences and improve risk analytics. So that's another driver that we see the regulators focusing on. And in terms of innovation, we know that there has been many different products being created. An example being parametric insurance that we are seeing increasingly used. So I guess that takes us into the next slide, Mark. So here, this slide talks about key general insurance focus areas from both a conduct and prudential perspective. But I want to focus on the first three on this slide, given they have more, they are more in tune with this audience as they reflect more of the FCA's agenda. So it will be of more interest. So on operational resilience, which is the first key theme here, we know that by now firms should have, in line with the FCA and PRA policy on operational resilience, by now firms should have identified their important business services and their impact tolerances. And we know that there is a deadline of March 2025, so not long left now, for firms to evidence how to deliver important business services within impact tolerances. Now, whilst many insurers are caught by this new policy, it would be right to say that some intermediaries will be too, given this captures enhanced SM&CR firms, which may be some of this community. The other thing I think important to mention here is cyber hygiene. So cyber hygiene, as we know, is important, and to do this, firms are expected to simulate a range of cyber testing scenarios to remain resilient to threats. Moving on to recovery and resolution. So a key topic from the FCA perspective, and we know that the FCA has specific rules on within TC 2.4 around adequate resources and wind down plans. So all FCA regulated firms are required to hold wind down plans, so that should the situation arise where activities need to be ceased, this should happen with minimal adverse impact on clients and wider markets and all stakeholders that this audience and other insurance firms will have. So interestingly, the FCA a couple of years ago did a review specifically on how general insurance brokers assess liquidity for wind down planning. And while some good practices were identified, so were some improvement areas. So this included strengthening risk management frameworks, enhancing wind down planning and liquidity modeling, and regular reviews of wind down planning. So that takes us on to the third theme here on ESG. So, I mean, this is a very broad theme, as many of you will recognise. So I guess one of the things that is worth mentioning is that last year, around May time, the FCA introduced a new anti-greenwashing rule from a disclosure perspective that firms will need to think about. And then, of course, we have non-financial misconduct, which the FCA has been looking at for the last few years now, and in fact is expected to finalise its rules before the end of this month on non-financial misconduct across sectors, so not just for insurance firms, but for all sectors, which includes this audience. So when we talk about non-financial misconduct, obviously we're thinking about bullying, harassment and abuse. And the final rules are expected to include sort of FCA expectations around what firms should do where there is a finding of non-financial misconduct. And this might have some linkages with employment remuneration, such as clawback, for example. So really interesting policy coming out very shortly. And then on wider diversity and inclusion rules, these rules are expected to be finalised in the second quarter of this year. And we know that this will include topics like D&I monitoring, regular reporting on D&I, public disclosure of D&I metrics, And firms will be expected to be able to set D&I specific strategies, which should be data-driven. So I guess the last three themes on this slide kind of focus more on things from a prudential aspect, but I think it's still worth briefly mentioning. So on financial resilience, we know that credit markets are exposed to economic uncertainty, which we've already touched upon, and it's important for firms to have sound, and so it is important for firms to have sound credit risk management capabilities. Another important theme is claims inflation within GI. So firms are, of course, expected to be alert to the risk of excessive optimism on reserves, pricing, and reinsurance planning. And just on finally reinsurance, it's very important for firms to, from a regulatory perspective and otherwise, to look at the health and reliability of reinsurance partners for the full duration of the exposures, the full policy of the reinsurance contract. So that's hopefully some of the key themes that will have been of interest to you and that you recognise in your day-to-day discussions with the regulator. So here I sort of have picked up key themes from a conduct lens in particular, and we've already kind of touched some of the themes on the left-hand side, which are operational resilience and ESG, so I won't discuss them again. And we'll later discuss fair value and consumer duty. So putting that to the side, on the right-hand side of your screen, you'll see references to two different insurance portfolios. So you'll be aware that the FCA has three insurance portfolios. One is personal and commercial lines. The second is wholesale markets, which is Lloyd's and London market, of course. And then you have life. So we didn't think life was relevant for today, so we haven't included that. But in terms of the two that are there, I'll just pick up a couple of key priorities from each one. So starting off with personal and commercial lines, a big priority for the FCA in this kind of sub-portfolio is greater oversight of appointed representatives. So the FCA found this subsector in particular to have a very high number of reported crystallised AR appointed representative harm cases. So this is why it's become a focus area for this subsector. So what the FCA has done they have sort of enhanced the appointed representative regime. So there are increased reporting requirements and increased expectations around how appointed representatives are overseen by principal firms. And the other thing I think important in terms of priorities for this subsector is the GI pricing practices evaluation. So the FCA is looking to publish its findings of its evaluation of the pricing practices remedies that it enforced between 2021 and early 2022 around how new business and renewal prices for home and motor customers should be equal, where the risk profile and the method of purchase is the same. So that will be an interesting evaluation to take note of and understand the implications of as well. Now turning our attention to wholesale insurance market, just pick up one or two from here. So one priority here is non-financial misconduct, and I've briefly touched it already in terms of overall priorities, but for this subsector in particular, the FCA has been concerned and voiced its concern over the last couple of years. There's been lots of pressure as well on the FCA. There's been kind of sort of media reports as well coming across on this subsector and non-financial misconduct. In fact, the FCA, in quote, have said that this sector has a long way to go in developing inclusive cultures where people feel safe to speak up. So if you are operating in this market, or if you are working with other industry peers within this market, then it will be an area that you will want to follow closely with regards to the coming out of the final policy later this month, as expected. So, and then just briefly to mention on this slide, of course, within wholesale insurance, markets are very, global markets are very interconnected. There's lots of international operations. So firms will want to think very closely about how to prevent financial crime, particularly what their sanction controls look like and what their anti-bribery controls look like as well. So that's another key topic that is worth mentioning on this slide for wholesale insurance firms. So on this slide, I think this is, I guess, so to speak, the elephant in the room, because this has been the biggest project of the FCA for the last couple of years now. So we won't talk today about what the consumer duty is, as we all know what it is. But I think what's interesting has been to see kind of the trajectory of thinking, or the way that the FCA has been supervising firms since the introduction of the consumer duty. So in terms of its recent focus areas, we know that the FCA has been looking at fair value very carefully, and it asked gap insurers to suspend sales last year, as we know, due to fair value concerns, and only some were able to enter the market again, where they were able to prove that or evidence that they were providing better value. And then on outcomes monitoring, the FCA specifically carried out review in the insurance market space in terms of how firms are monitoring good outcomes under the consumer duty. And the FCA did identify some good practices, but also some areas of improvement. So, such as it found that many firms were focusing heavily on internal procedures rather than actual outcomes. And it wasn't really clear how some firms were looking at different groups of customers, such as vulnerable customers. So definitely some thinking there for firms to do in terms of how they monitor outcomes. There's been a number of other reviews that the FCA has done in other areas, including on the annual board report submission, which is a requirement for all firms caught by the consumer duty to produce on an annual basis. Again, some good practice there and some areas of improvement identified by the FCA. One example of an improvement area is that there was insufficient data in some of these board reports. So again, something for firms to think about in terms of their next submission to the board. In terms of go forward focus areas, so still lots going on in terms of understanding how the consumer duty has been implemented by firms and whether good customer outcomes are being sought. So I think the first point to mention is around fair value. The FCA have announced and launched, in fact, a market study on premium finance. So they're not only looking at this from a fair value perspective, but they're also looking at it from a competition perspective. So, so the FCA launched this market study late last year, and they are already concerned about the related interest and APR charges. So it's more about understanding the level of harm, whether customers understand what they are buying, and whether they feel like they have a choice and they're able to make informed decisions. And lastly, to also look at the dynamic between the provider and the intermediary to understand if there is a conflict of interest, such as in terms of commission and potentially misaligned incentives. So lots for the FCA to focus on going forward. And I'll briefly mention the claims handling arrangements review as well. So this is due to look at general insurance claims in particular, and this is due to come out, the findings, in the second quarter of this year. Thank you, Mark. So briefly, we thought we'd touch upon AI, given the last couple of years we've seen this kind of huge bubble in around AI, and firms and industry using AI more frequently and evolving more than it has ever before. So I think the most important thing to note on AI is that the regulators have made clear that they do not plan to make any rules or any new guidance on around supervising AI. They want to do this within the existing regulatory framework. So when we talk about the existing regulatory framework, we're talking about topics like SMNCR, consumer duty, and operational resilience. So while there are lots of risks attached to the AI, the regulator recognises there are lots of opportunities attached to it as well. And in line with its thinking and alignment with the way that the government is trying to focus on international competitiveness and growth, the regulators are keen to not hinder the use of AI by firms, and in fact for it to be used in a way that is safe and acknowledges the risks. Therefore, some of the areas of focus that I've identified here will be of relevant, as I mentioned, such as consumer duty and pricing, and making sure that prices are fair and justified. And then if we skip on to the next slide, Mark. I think that's the wrap-up slide. But I think what's interesting is, after discussing all of the risk drivers and all of the regulatory hot topics, to understand what this actually means and how the regulators are supervising. So just on skilled persons reports, for example, we are seeing that the FCA has increased its use of skilled person reports and putting more of the onus on firms to identify potential issues and rectify them. So, for example, in 2022, there was only one Section 166, and this increased to 12 Section 166 reviews in the GI space in 2023. So you can see a clear increase there in the trajectory that the FCA is travelling. Another important tool that the FCA is using is data-driven supervision. So before, where we might see the FCA focus primarily on regulatory returns, such as complaints, to identify any issues or trends, we're now seeing them use increasingly social media platforms to understand, what are the key issues, what are people complaining about, what are people unhappy about, which firms are outliers, and this includes all players within the insurance market. So definitely relevant for this audience. And I'll just briefly touch upon stress tests. This is, of course, a mechanism that both the FCA and PRA use to understand where firms are in their testing and understanding of their vulnerabilities and what they're doing to increase protection in those areas. So that takes us up to the end of this section. I don't know if we want to have questions now, or if I hand over to you, Alex.
Thanks, Sonia. Look, I will keep this really short and sweet because I'm keen to pass over to Mark and give him plenty of time to cover his section as well. But just a big thank you, Sonia. Really appreciate that. Lovely to meet you all. I'm Alex Juniper. I'm a director in our insurance risk and regulatory team here at PwC. I think key message for me, just to kind of close this out, was to say we're close to an awful lot of these topics firsthand through both the advisory work and also the managed service type support that Tim touched on at the top of the call, where certainly from my world and my perspective, we're actually supporting clients directly within their risk and compliance functions. If there's anything that's popped up today that you would just like to hear more on, please feel free to reach out to any of us and we'd be really happy to set that up. And likewise, just we want to make these sessions as valuable for you all as possible. So again, any themes that or topics that are of particular interest, please feed it back to ourselves or the team at the MGAA, because we're hoping to do some more of these sessions in the future, and we'll very much do our best to make sure we're covering what's valuable to you all. But no, thank you again, Sonia, really appreciate it. And Mark, I'll pass across to you.
Hey everyone, on something a bit different. So, Mark, I sit in our insurance asset and wealth management and finance transformation practice. I've spent the last 15 years of my career doing finance transformation, which has nobly started out as trying to help companies grow, but has actually largely been a cost-saving exercise for the last 15 years. But what I want to do here now is kind of set the scene for finance of the future, or our perspectives of it. I don't think you'd be surprised if we were talking to PwC and we weren't having that conversation. It will be a whistle-stop tour. We've done whole 2-day events on this. What I would say is, if there's people that want more and want to have engagement, we'll provide contact details, and actually we'll be looking to set up some sessions for this community to kind of bring people together and have more debate and discussion on these kind of topics. Yeah, so that's that. I think I would be surprised if there wasn't a level of professional cynicism from all of you saying, well, why isn't yet another consultant sat in front of me talking about finance of the future, and we've heard this all before. Our track record has been, I think poor would be a very polite summary. I look at those predictions and I think it's very safe to say none of them have come true. That there's reasons and rationale for that. But what I would say is over the last 15 years, there's been very little change, but in the last 2, we're suddenly starting to see quite a lot of change. So I think the opportunity for us as finance leaders to reshape these finance functions and completely reinvent them along with the businesses that are being reinvented is what gets me out of bed in the morning. I think this is a really, really exciting time to work in finance and deliver some of this stuff. I'll just talk quickly and throw questions in the chat. It's very odd presenting to 40 odd people on black screens, but if you've got questions, feel free to throw them in the chat. I'll try and address them. Where do I see finance today? Very interesting if it resonates with people on the call. Despite years and years of transformation, it's cheaper than it was when we started. It's probably got a similar number of FTE. Larger organizations have just thrown things offshore into nearshore. But when you actually lift the lid, it's still 70% production activity, and even of the insight roles. I mean, I did a survey at a couple of large insurers, and 70% of their higher paid insight staff were doing production, handle turning, data manipulation. Very, very little insights being generated. And when the business is asking the difficult questions around new products or new channels or new customer views, it's very, very hard for finance to adjust to that. And the roles fundamentally have barely changed. AP clerk all the way through to business partner, they're the same roles that were there when we started. It does feel different because I think that it's facing as a function across industries, not just in the insurance space. It's really facing into a perfect storm. So the business is top down for the first time putting pressure to say we need more, we need it now, we need different views of the world. The regulators, as Sonia and Alex have just alluded to, are becoming stricter, and actually I can see a world where they want direct access to data to see the report themselves live. And then the workforce actually is putting an upward pressure on. I've experienced a number of clients where they've had long tenure staff, specifically in the operations space, where they're finding suddenly they've got turnover, and when they bring new people in, there's faster turnover. People just don't want to do the same kind of jobs that we train doing. And I think the good news is that those pressures are genuinely there. We may not have got to where we want to, but the technology that's required is fundamentally changing. And whilst it's promised a lot and delivered very little, and RPA is the best example of that, it delivered almost nothing in finance. The new technologies are going to make a fundamental difference, and I'll come on to that quickly. In terms of where finance is today, typically see 3 things. So an on-premise, or when you move to a cloud ERP, possibly planning or console systems around it, and then Excel, and more Excel, right? And that has barely changed. That was the traditional architecture. The modern architecture is going to look completely different to that. And that is starting to emerge, but it's fundamentally going to be around large data stores of structured and unstructured data with an ERP with standard processing and faster kind of performance times, and then bespoke point applications all the way around to do specialist things, from regulatory reporting to treasury to accounts payable, accounts receivable. You will start to see specialist systems going all the way around, kind of best in breed. That will be the modern architecture. That will start to deliver some of the transformation. But if I look at what's truly transformative, I would say the cloud and the ERP. So having those standard processes, the standard controls, finally winning that war on process optimization. Data and AI. So I think it's time for finance to accept that we've not what got our way in terms of putting really good rules around data and structuring it. I mean, that's what we always wanted to do. I don't think we've gotten there, but I don't think we need to get there anymore, because the ability of AI and the capacity of those large data stores to store all the data we need in this kind of really traditional finance structured way, as well as the unstructured, means we can get loads of insights out of the data in there if we can just get it into one place. And then the third one that was kind of a buzzword a few years ago, but has kind of largely disappeared off of the radar at the moment, I think will come back as we start to see the architecture emerge, which is around blockchain. And the reason I think that is because that's where you're going to get your event-based contracting done. So you will have smart contracts with rules built into them, and that will say, well, if X happens, we need to make a payment. That's going to be the unlock of instantaneous transacting and processing. It will also be the solution, I suspect, that kind of is used to eradicate the back and forth where there's partnerships between carriers, brokers, insurers, etc., where there's two different versions of the truth. You will have one version of the truth, and there will be systems that emerge to deal with that. So I think that's where it's going. We have insurance reference architectures. I can talk through those. We can dive into some of those systems and demo them if people want to see it at a later date. But fundamentally, that's where it's going. I wanted to bring in a couple of tool sets that kind of could actually start being relevant to you now, rather than that kind of the futuristic stuff. So on the left, that's the death of consulting. That's when people like me disappear, and you can start doing this yourself. And that's the discovery technology that you can use now in kind of change projects on a point basis. So, single time use type of things. But in your future architecture, when you've got standard systems and you've got everything flowing through and finance is in that place, you'll have process owners that use these tools as their day job. And this is what they're using to innovate and to drive improvements. And there's three of them I've listed there. There's so many more, but Celonis will be, or equivalent tools will be, mining your data and your tasks and your keystroke processing, and we'll talk about how every process is working versus the happy path it should be working on, and enable you to see all the breakpoints, etc. You'll have the Yuka as a PwC tool you can put onto your hard drive, and it tells you how many spreadsheets you've got, how much risk is in them, how they all talk to each other, where the hard-coded cells are, etc. You'll have that as standard, this kind of risk register of your off-system spreadsheets. And then you'll have tooling that enables you to kind of model changes. I want to start all my month-end close processes on day one. What's the fastest it would close? I want to add this step in. What would that do to it? You can do that, and the data will be there for finance professionals to do it. The last one, Capsify, is an example of an operating model type tool where you will have a complete framework of your processes through to your controls, through to your KPI dashboards, to people, to role profiles, and that will become standard. So that's the left. You can experiment with those tools now. On the right is putting coding in the hands of finance professionals like you. So I think they've got an immediate use now to drive productivity, capacity, and de-risk. And in the longer term, they will be used to plug gaps in the architecture, or more strategically. So they might integrate systems, or they might be a tool to get systems to talk to each other. Kind of three buckets: the data wrangling and all tricks, that Excel on steroids. That is going to get rid of your Excel architecture. Power Query is everyone that uses Excel has Power Query available to them, but it's more powerful macros, and it's more controlled. So in Alteryx you can map out the process flows. So the death of these spreadsheets where if someone walks away, no one knows what happens. All that kind of drag, drop, manipulate, calculate. You can set it up so if you're doing the same thing every month, you click a button, it all runs through, almost like it's systemized, and it can be coded by people like us. The data visualization, I suspect you all have and use and love and are familiar with. And then the workflow tools will be where you've got multiple systems. It will be sitting on top. It might sequence and kind of schedule processes, but actually it will be that kind of control framework that throws across the top and gets rid of key reliance on approval by emails and inboxes and shared drives, etc. So that's that. It would be negligent of me not to talk about AI. I don't know if people have been using it and want to put into the chat some examples of where you might have been using it or thinking about using it. When I started doing this presentation 2 or 3 years ago, I got eye rolls. About 12 months ago, people started to kind of be a bit more interested, and now the question is, well, I'm not interested in what AI is. I want to know where I do it first. And it's kind of it's incredible how quickly that conversation has changed, with the rollout of Chat GPT being the kind of driver for that. What I would say is it's not actually that new. So in a finance context, you've been using machine learning for OCR on your invoice scanning for years, right? What has changed is it's gone from that kind of heavy, hard to train models where you show it enough pictures of a tractor tire and it knows it's a tractor tire, through to actually training itself on really large data sets. So this kind of deep learning capability, as well as its ability to interact with you like a human would. It can understand your inputs, but it can provide outputs that you can interpret. They're game changing. And I think that really then starts to open up a plethora of use cases, from summarizing and searching large data sets through to transforming, augmenting and formatting data, or even creating new content. And I've pulled out here a couple of areas where I think for finance it might be relevant, but it's just a couple. That there's more. I think if you take and I should say these are vendors, but there's more than these vendors, right? It was just examples. On the accounts payable side, Vic AI is an example of a tool where they've trained it on 1 billion real-world invoices. So where your OCRs tended to have acceptable kind of success rates, this is into 99% very quickly, but it does more. So I've seen an example where it codes a handwritten post-it note, because it knows, looking at your ledgers, who typically buys from that supplier and what ledger code it should go to, and it auto routes it for approval via workflow. So that pain of non-PO invoice processing can, in theory, be taken away by technology. It can also do stuff like looking at your payment runs and saying, well, actually, how do we optimize payment for working capital purposes, etc. So there's other tools. Softco's another one. There's a few of them. On the accounts receivable side, similarly, High Radius is a good example of a tool that can do auto matching of balances from the bank statement through to your receivables ledger, based on it loses logic. So, well, these ones are definitely there. These ones, for an X% of certainty. So, those backlogs of matching can go away. Cash flow forecasting can proactively look at payment history of customers and say, well, actually, this is these are the ones we need to collect, and this is dunning and you should do it now, or actually these ones need phone calls, etc. So using insights that we've previously relied on the AP and the AI clerks to drive, the technology does it. In the more advanced space, we've built for a life insurer actually an analytics power cloud that was doing things like enabling them to run proxy models to replace their heavy models in seconds rather than hours. It would then say, well, the result is this. Here are the top 5 drivers for the movement. Here are the top 5 things you need to look at. It would auto-generate the commentary. That's definitely that kind of augmented analytics is where it's going. And then the bottom right, this everyday productivity, which is where I suspect if you are piloting it, you're already doing so. But I can actually see someone's got a note taker on here, so someone's already using it. But automatically taking notes on meetings, composing emails, finishing sentences, analyzing data and finding trends in Excel. Copilot is built in into all the Microsoft tools now. So it really can be game changing. Just how game changing is open for debate. But actually, I put this slide up because I wanted to be slightly provocative. But if you go down to the individual processes, I think there's a good argument that there's nothing to stop it. this is a finance on a page, an insurance company finance on a page representation. Green is partially automated or decently automated, kind of augmented. Black is fully automated, it's gone away. Red is no automation, so kind of the VAG rating. If I drew this today, and we do this, it would be largely red and amber. But within 5 years, I suspect it's going to look like this, if not faster. And you're going to have to repurpose the operational finance roles from doing to kind of to understanding and overseeing and optimizing process using those tools I talked about earlier. This kind of the discovery tools. They specialist finance, they're going to be freed from the production activity to kind of the heart of a modern finance function, really innovating, driving specialist content, or especially staying on top of the regulatory agenda, orchestrating between external stakeholders, the business, etc. And then the business partners, who are traditionally kind of the accountants that are then partnering, influencing the business. It's going to become much less about technical accounting skills and much more about your ability to interpret data, to communicate what that means, and to influence behaviors, because all of the kind of the analysis will be done for you. I think the question for me is less about can that be done and how, because finance is not the only area of the business that's being disrupted. It's very unlikely to be at the front of the queue for investment in that context and or the technology skill sets. So the big question for me that at the moment is not answered is how are companies going to deliver the technology, the architectures they need to achieve this, and at what speed. My hypothesis is that they're going to use third parties to do it, and we're looking at, well, we've started a managed service business for that purpose, because we think those third party outsourcing contracts are going to go from bums on seats in lower cost locations to actually take our processing, deliver the automation for us, because you'll have the scale across multiple companies, and actually just leave us to focus on what's truly differentiating for our organization. That's my hypothesis and where it goes. The alternative is it just takes a longer time to get there as technology scales and the costs come down. And then I just wanted to finally touch on what that means for people. So my children are 9 and 7, and there's numerous studies published that shows they are more likely than not to enter a workforce, into a job that didn't exist when they started school. And actually, when you look at that previous slide, that kind of tells you that might well be true. And as a parent, that makes me think about what skills do I need to equip them with, because the standard skills that we were brought up with probably aren't what they're going to need to succeed in the future. And if you start to think about some of this, the way I was kind of thinking back from the future problem to kind of solve that, and actually, I think what you're going to start to see, and we are starting to see, is finance with a completely different skill set and role makeup. So you'll see data scientists in the finance organization. I'm talking to a finance organization at the moment, but there's a kickoff call going on at the moment where they've built the data layer. Now they're like, how do we recruit the data scientists to start innovating, building the AI models, and start driving efficiencies? I think process operators will become process owners, and you'll have fewer of them, but they will be responsible. Instead of doing the doing and checking, they're going to be about, well, how do I continuously innovate on this process, and how do I drive standards and control? They'll work with DevOps leads to kind of innovate and drive that innovation. Data ownership is going to be absolutely critical, and we cannot go in the world where we just throw everything in there and no one cares about it. People within organizations are going to have to be appointed owners of data, and they're going to have to understand who uses that data for what purpose, and they're going to get scored. You can see this kind of world where everyone has like a kind of a web portal where they get star ratings on their performance, and that directly links to their remuneration. So people give them feedback on the extent to which they're controlling the data that they need to use it use. You will have reg tech managers who are thinking about how do we stay on top of, how do we drive technology to stay in compliance with the regulatory changes. You'll have innovation officers that are kind of prodding and poking people to think differently. And the commercial business partners will be far, as I said before, fewer accountants, much more on behaviours, behavioural change, broader market trends, etc. So that's everything I wanted to cover. It really was a whistle-stop tour on that. If there's any questions, feel free to put them into the chat group or follow up with me directly afterwards via email. And I think we just wanted to close, Tim, on covering the survey we're thinking about or we're wanting to launch.
Thanks, Mike. Yeah, really quickly, and then I've seen there's already one question that I think is out there for the reg team, and then obviously any other questions or anything else Sarah needs to do. But as Mark mentioned, we wanted to launch a survey focused on MGAs and finance and risk, really for two reasons: to help us understand you and the market in even more detail, but also be able to play something back to yourselves to understand kind of where you benchmark across your peers in those functional areas of finance and risk. So the intention is that we'll launch this. It'll be over 10 minutes tops to complete, focused and aimed at kind of your finance and risk compliance leaders to complete, and it'll look at your company, your strategy, but also kind of what you're focused, what you're looking to try and do, and your capability from finance and risk perspective. So those are where the questions will be focused. And just very quickly for me, onto the logistics, we'll coordinate with Sarah and the MGAA team after this, kind of getting that survey out there with yourselves. And what we'll then look to do after probably a few weeks of kind of getting the data in, we'll process some reports, then obviously have something we can kind of share that's bespoke for each of you individually, organisations to look at. And obviously we're more than happy to, after that, to follow up in more detail. But that's really all I wanted to say on that. Sarah, perhaps looking at you, should we start with the question that's in the chat, or are there any other questions you think we should start with just before the time that we've got left?
Yeah, absolutely. Thanks, Tim. Yes, so there is a question in the chat, which is from David. Hi, David. He's asked, what changes do you anticipate following the FCA discussion paper on the regulation of commercial and bespoke insurance business? So that's for your regulation guys.
Thank you. I'll take that. Thank you, David, for your question. So this is with reference to the discussion paper that the FCA put out last year around making the rules, FCA rules, more proportionate for commercial insurance and bespoke insurance. We know that this was an area of great interest for industry, which has lobbied hard actually for this area to make the rules more proportionate for commercial insurance firms, because while the discussion paper closed in around last September, October time, it got reopened at the end of the year and only just closed earlier last month. So in terms of the changes one can expect, I think the FCA made clear that they want to look at the definition of large risk, but at the same time, they want to ensure that SME clients continue to be protected. So, and I think this is with the lens of the consumer duty. So when the consumer duty came into force, I think many firms with large risk and SME type clients found that they were caught by some of the requirements, which is quite different from traditionally the way the ICOBS is set out, because that traditionally has applied to retail customers only. So I think we can expect the FCA to have a real think about, and obviously engage with industry at the same time, how the regime can be made more proportionate, how the consumer duty can apply in a more proportionate way, to kind of reduce the burden on commercial insurance firms where sophisticated customers might not need the same level of protection. There is also something around bespoke insurance as well. So the FCA is aware that not many firms are using the exclusion within the prod source book around for intermediaries that are writing bespoke insurance. So it's clear that the FCA want to make this more prominent, or perhaps make the rules clearer so that intermediaries can benefit from this exclusion. I think it remains to be seen what the FCA does in that particular space. But I think we would all hope that actually they look beyond that and make it clearer what, when firms do, for example, fair value assessments, who should that be? Who carries the most burden, whether in terms of the distribution chain between the manufacturer and intermediary, as we know that MGAs are caught in that chain as well often. So it'll be interesting to see how and to what length the FCA clarifies its rules in that area. But we are still at the DP stage, so obviously there has to be a consultation before final rules. So it's definitely an area to watch.
Amazing. Thanks, Tanya. David, I hope that's answered your question. I've certainly sounded as though it did. There aren't any other questions in the chat. So we have got a couple of minutes. If anyone wants to ask anything else, now is the time, or forever hold your peace. But otherwise, you can, of course, follow up with the PwC team, as I've mentioned, with any questions you've got after this session. And we will also liaise, as Tim has mentioned, with regards to the Finance and Risk Survey and how we're going to get that out to yourselves and other MGA members. So if there isn't anything further, doesn't look as though there is, I'd just like to take this opportunity to thank you, PwC, and to Mark, Tim, Sanya and Alex for taking the time to talk to our members today. I think it was really insightful, and we hope that you've all taken away some valuable practical tips. Before we finish, if you've not done already, if you could please complete the feedback survey, which we'll also send along to you via email alongside the recording of the session within the next couple of weeks. And do also have a look on the MGA website for any other forthcoming events that we've got coming up. It just remains for me to say thanks once again to everybody. Thank you all for joining us. Hope you found it informative and it was a good use of your time over lunchtime. I think it was. And thank you very much, and look forward to seeing you on another briefing.